giants are spending big again on AI this year, but when will we actually see AI's impact on profits?
That's going to take a long time.
It's a process in terms of actually impacting productivity and really turbocharging profits. It's going to be years from now.
So does that mean AI is only a tomorrow story? Not necessarily. Think physical.
There is a lot of interesting things to invest in right now. As we think about AI in the physical world, it needs a lot of input.
For example, with robots, 60% of the cost of a robot are high torque actuators. And the arm of a Optimus robot, there's 26 of them. So they're very complex, they're expensive. There's not a supply chain in North America to build them.
The Money Talk Podcast, brought to you by TD Wealth with Kim Parlee.
Hi, everyone, and thanks for joining us. We are here with a couple of fan favorites. I'm here with Michael Craig. I'm here with Kevin Hebner, and we're here to talk about how investors may need a whole lot more patience when it comes to AI investing. Hello to you both. Nice to have you both here.
Our pleasure, Kim.
Let's start off with Kevin. You put out this piece. What is the title of this piece?
The title is AI Will Eventually Turbocharge Productivity and Profits, but with the emphasis on the eventually.
Okay, and what does eventually mean? Let's do the bottom line first. Are we talking months? Are we talking years?
So it takes a lot longer than most people, particularly the techno-optimists, believe. And it's always the case with the tech wave that these things take much longer than the cheerleaders would lead you to believe.
Okay, so I'm gonna keep asking. So is this a years or is this a decades piece?
So it's a process. It takes a long time, but in terms of actually impacting productivity and really turbocharging profits, it's going to be years from now, certainly beyond 2030.
Okay, and Michael, maybe your perspective, is this priced into the market right now?
Right. So markets have had a long history of bidding up new inventions early, only to be dissatisfied with not getting the returns right away. So is it bid up? Yes, of course it's bid up. You put any .ai behind any company and it's rallied. And ultimately, the way these things tend to work is there will be some fantastic companies that emerge from it, and there'll be a graveyard of companies that fail. And I think that's the lesson of history. That's the lesson of recent history. Fiber optic got laid in the 2000s. A lot of companies went bankrupt, but it's been a godsend in terms of being able to communicate and use, the various incarnations of the internet. There's no reason, historically, the evidence points there's no reason why this phase won't end any differently.
Yeah, and I think there's been a lot of volatility in the markets, and Stephen, in the past few weeks, just as people try and triangulate a little bit of this in terms of when are you going to see the benefit? I mean, I think everyone truly believes there's benefit coming.
Yes.
It's just not something maybe you can bank right away, which is what we're looking at.
I think there's different kind of ledgers of benefits. There's humanoid robots, which Kevin writes about and can give a lot more color on. Which
I want humanoid robots. I want data from space.
That's really, really complicated, and that's probably decades away.
Yeah.
And then there's what you're seeing in the software programming world with Claude, where if you went on a beach for a month and came back, you're totally out of date. The speed of innovation and the ability for a creative person who historically has had to work with developers to get a concept built that might take months, quarters, years, now can do it quite rapidly using Claude code. And so you're seeing a real, in the software area, you're seeing a major disruption. But it's important to think that AI is more than just writing software code. It's just an application of software code.
Yeah.
And so there'll be fits and starts with things that move quickly and things that are going to take. And I think that the big differential is the complexity and the resources. Code is just writing lines of code, whereas building kind of things take materials, other types of technology, whatnot, batteries, and that engineering is still years away.
Yeah.
And I would say on the volatility, I'd say there's two different angles. One is the market is beginning to realize that the time frame for the benefits for all this investment in AI is going to be longer than the cheerleaders would have led us to believe last year. And the second thing is we are starting to see the creative destruction, and Mike was mentioning in the software sector, and it certainly does make sense. AI is already quite good at writing code, customer service reps, marketing copy, things like this. And we've recently seen some of the software companies, including the really big ones, the top 25 global tech companies,
Yep.
really selling off dramatically in the last couple of weeks. So I think it's the two things. And I think they're continuing to play out with a lot of vol because the uncertainty is going to last not just quarters, but years and many years.
Yeah, and I think, if for me, as I'm thinking about this, and I think what a lot of people want to know is that, has too much upside been priced into the market perhaps already? And I think you've got a thesis here we can talk a bit about.
Yeah.
One of the things you talked about, and correct me if I'm wrong, but there's 600 billion, I think is the estimate of what the AI CapEx was going to be this year.
Yeah.
You're showing that companies are not talking about an adequate return on investment on that CapEx yet.
Yes, that was 600 billion. That's an estimate. We'd have to put that up about another 100 billion. I created that chart about a week ago, and since then we've had Microsoft.
See, when you do go to a beach, things change. So I was going to say,
and so Microsoft, incredible number, $180 billion on CapEx this year.
Yeah.
This is unbelievable number. We haven't had numbers like this in history. So a lot of money upfront investing, and just the return to this is going to take a long time. And so at some point, we will have to see investors in these companies saying, we want to see the returns. It's going to take a while till we get returns out of the little circle. And so I then think we get CapEx growth still positive, but into a lower, more sustainable trajectory.
Why let me ask it this way. Are investors suspending disbelief a little bit still on the CapEx side? Like, it will come, it will come, it will come. But when does the penny drop?
Yeah, I think that we go through long periods of time when, and this one has really started in 2011, where an ethos gets created, and we've been in a cap light world and high free cash flow, and everyone's created nice mousetraps and made a lot of money, and the margins have been infinite. And this is not the first time this has happened. Yeah. And you get to a point where you kind of run out of room. It's the Wile E. Coyote moment. It's like, oh my gosh, we got to invest. Yeah. And so now, as an investor, rather than looking at companies with kind of infinite margins and pricing power, you have to shift your focus to, okay, now we're going into an asset heavy world. Who are the best capital allocators? Who are going to...
So when you say asset heavy, and I just want to make sure, because not everyone's into, deep in the market. So what do you mean by asset heavy?
Okay, imagine you make a CRM software.
Yeah.
Right? You build it, companies buy it, subscription model, constant cash flows. You add new bells and whistles to it, but it just evolves. But there's no huge R&D into it, and you have those subscriptions, and you grow and the incremental customer costs you nothing.
Yeah.
Right. So it's wonderful business.
Yeah.
And you think investors start to believe, like, let's just say that's maybe a microcosm of the market. Investors think that's the way the company should work, and it grows and grows. And then you get to a point when you have a very disruptive technology like AI, and all of a sudden that those priors get flipped, and all of a sudden there isn't a moat, and this isn't something that's going to go into eternity. Now, if you think about simply pricing a stock, what are you pricing? We're pricing future earnings that grow at a certain rate, discounted by the risk of the company. That's kind of basic pricing formula. And if you all of a sudden create uncertainty on your earnings, and then if they're leveraged, you start putting uncertainty on what you discount it back, so the discount factor goes higher, the earnings become uncertain, you get pretty tremendous moves in the value. And that's what we're going through right now. And so this is it's a fascinating time. I love it. I find, as an allocator, a capital allocator myself, to be this is what gets me going in the morning, because we are in one of those periods that in a career we may see this happen 4 times. The last one happened in 2011. Part of that was 2000. Part of that was late 80s. Part of that was 1980. Yeah. And so history, once again, like, this is why when you invest, you have to understand the history. Because humans we do it all over. We go through the same cycles and make the same mistakes that our previous ancestors made, and I don't think this time will be any different. So that's kind of where I think things are right now. And again, the tricky one with this is, like, Kevin and I were talking. Those who had forecasts of what the internet would look like in 1995 were all totally wrong.
Yeah.
And we are not clever enough to say this is what AI is going to look like in 5 years. I have no idea. Yeah. Yeah. But I know that whatever it looks like, it'll be far more broader, and disruption be far more broader than probably we can take in into thinking today. So that's, I think, the thought process, and it's going to lead to an extended period of market volatility at a time where the largest U.S. stocks make up 40+% of the index, at a time when everyone's bought into passive investing. And I would make the case that we're probably at the end of that road.
It's funny. I was waiting for. I think the thing I'm trying to digest right now is I think the experience of people. Like when I look at your thesis and say, okay, so the first one is that the ROI is going to be low for a while, like on initial capex. But yet we see these huge moves, right? Where it's like legal platform software sells off by 40% in one day because AI can do that too. And I think I think there's a disconnect from maybe how it feels in the markets versus maybe what you're saying in terms of where it's going.
And I think there's the hyperscalers, which are producing so much free cash flow.
Yeah.
And so some of that now is getting invested. So we're seeing that with Google, with Meta, with Microsoft. So huge amounts of cash flow. And so investors aren't really pushing back on that too much. But then we're going to be having some companies going public this year.
Yes.
Say Anthropic, OpenAI. They need a lot of cash. They don't have free cash flow yet. And they're going to be releasing a lot of information to markets before they go public. And I think there's going to be a lot of pushback there because, do these companies have real moats? An AI model, is that a real product? Or are you going to be competing with the big hyperscalers with so much free cash flow, with the Chinese open source models? How is this going? What is the route for them to free cash flow? And so I do think, some people will say there's an AI bubble, and I think that's far too broad a term. There are issues in the LM world. There are issues in the private world. And I think a lot of this comes to head this year with a couple of these IPOs.
There's a couple things I had the intent of going in order, and I am not doing that anymore. So first thing I want to ask about is IPOs. Why are those companies tapping the public markets? Because one thing I've heard, and again, I don't work on the debt side, but I've heard lots of people, they've done a really great job of tapping debt markets. So then why are they going to public markets? Dumb question. Like, do they need that much more to kind of fund what they're doing?
Well, there's a lot of people who've invested in those who'd like to cash out.
Okay.
It's super simple. Why do you IPO? You get access to more capital.
Yeah.
Fair. But early investors is an exit plan.
Yeah.
And part of that is an exit plan.
Okay. So and then we're going to get the information, what's working, what's not.
Yeah, and I think it's going to be interesting because one of those companies has a very clear business plan, and they seem to be delivering on that. One of the other companies is still throwing spaghetti at the wall. We're not really clear what their business plan is. And it's going to be very interesting to see how investors respond to that.
Yeah. You also said LLM is and I know that you talked about in your note about being a bit of a dead end for true AGI. Just maybe talk a bit about that.
Yeah, and so Jan LeCun, for example, who until recently was head of AI at Meta, he teaches at NYU, and he's one of the top researchers in AI. So he thinks that many people are LLM pilled. So they're so focused on LLMs. But if you look at LLMs, what they do, they are sort of stochastic parrots. They're good at saying what the next token will be. And that's fine in a world where you're trying to say what the next text should be, or you're writing code, maybe marketing copy, customer service rep.
It's good at grade 9 math too. I use it for my grade 10 math. I use it for my son.
So really quite narrow things.
Yeah.
But when we start to move towards autonomous vehicles, humanoid robots, either in an industrial setting or at home, we need very different types of models, what are called world models.
Yeah.
And this is a focus not just of Jan LeCun, but other leading researchers like Demis Hassabis, who heads AI at Google, and Fei Li, who's one of the real pioneers in sort of spatial intelligence.
Yeah. So this is a bit of like LLM is like, it's just the very, very beginning. Like this is Neanderthal, maybe in terms of where AI is going.
It's a very, part of the world is text-based. Fei Li emphasizes language and text doesn't exist in nature. It's something we created, but it's a very small part of it. But if we want to go beyond this, and Mike was mentioning physical capital, more of a capital-heavy world, which we'll be moving to with AV, drones, different types of robots. And robots will be the biggest industry ever, just not this year. It's going to take a while.
It's not in 2 years.
And for that to happen, we need fundamentally different AI architecture to get there. LLMs will not get us there. And Jan LeCun says it's a dead end. Other people are a bit more polite.
Yeah.
But that's essentially what they're saying.
So going back to the physical side, I guess that's kind of building the infrastructure to be able to fuel that. So
Yeah, and it's not code, it's real things.
Yeah.
It's all the electricity and the materials and the material science, and at a time when those are not in abundance.
Yeah.
Right? So that's we've got these weird forces at play where AI is probably going to keep a lid on wage inflation. And you see this in the US right now that hiring levels are quite low. We're trying to look at lower level types of work that can be done through LLM. So wages but real physical goods, like the price of making things and materials is going to be bid.
Yeah.
And so you get this, again, this kind of goes back to a thesis of ours where this creates inflation volatility. You get these forces, like tectonic forces at play, and once in a while one overpowers the other, and that's when you get earthquakes or bouts of inflation volatility. Yeah. So I think that is with us now for some time as industry evolves and looks to develop some things Kevin mentioned.
Yeah, and the changing nature of capital, so there's sort of intangible capital, so it's intellectual property, it's code, it's copyrights, these sorts of things. And then there's physical capital, so stuff you can drop on your toe. And so we've been really focused on the last 15 years on intangible. So we this pivot towards physical capital. So for example, with robots, so 60% of the cost of a robot are actuators, high torque actuators. For example, in the arm of a Optimus robot, there's 26 of them. And so they're very complex, they're expensive. There's not a supply chain in North America to build them. So that's a real challenge. You're picking things up, so you have to have some type of sensitivity, some type of skin, effectively, to do that. You're going to have a solid state battery, or these humanoid robots are going to weigh a ton, and then the battery will run out after 10 minutes. So we need a lot of progress in the physical capital space for robots, for drones, for AVs, for all the physical manifestations of AI. And I think that's a very different focus than we've had than the last 10 years or so.
It's different, folks. It's also really exciting when you start thinking about the commodity side and where the opportunities are and what's coming. You don't even know what you don't even know, to your point. But one thing you also highlight in your piece is just productivity growth versus what you talk about the techno-optimists expect versus what is actually going to happen. And you're saying you're forecasting a 0.4% productivity growth. Is that? I'm not sure what that's over the next. Is that per year over the next decade or
per year over the next decade?
Yeah,
which is significant.
Well, it's funny because when you say if I say 0.4, everyone's like yawn, but then you say go do a compounding and take a look at what it means, right?
The U.S. economy is that's like $800 to $1 trillion a year,
and that would be the biggest bout of wealth creation in history.
Wow!
So it's a lot, and the my favorite chart in the paper is a chart from the Dallas Fed. It shows U.S. productivity growth over the last 150 years, and it's always 1.9% plus or minus. It goes a little bit below during the Great Depression, goes a little bit above during World War II because we changed the structure of the economy, and a little bit above with Reagan and then the internet boom. But basically it's 1.9%. Right now, U.S. productivity growth year on year is 1.9%. And it's this idea that the economy is very complex. There's lots of layers. There's regulations, there's infrastructure, there's capital, there's layers, there's firms. And we might say, well, the intellectual property part of capital can change quickly, but the rest of society, the rest of the economy doesn't. And so to grow at 1.9% per year is actually really good. A lot has to be going on. And this is during a period in which we've had tech waves like railways, electricity, radio, the automobile, computers, internet, and now physical AI. So a lot's gone on, and we get 1.9%. And technical optimists will say, oh, we can do double that. We can do 4%. And, well, maybe they're right. And I think with all this stuff...
That's a charitable way of saying it. But
I think one always has to say, because you can't have too much confidence about anything, but there's never been anything like that before in history. And John Templeton would say that the 4 most dangerous words in investing are, this time is different. It could be. It could happen. But the weight of history is against you. So we think looking at what's happening with physical AI and how long it's going to take, 0.4 and there's a range of estimates, and we looked at the work of a lot of smart people in this area, but all compounding over time, that is a lot.
Yeah. Yeah. What about, and this is the one, because I was reading through, and I do read everything you do, and both of you do. It's quite detailed, but there's, you named some things like, commercial uncertainty and adoption rates you have to figure out, complementary innovation, the physical side in terms of things you're mentioning. But I can't help but think about just the geopolitics, especially when it comes to AI, because when I think about what drives, or what we're hearing is driving some of AI investment is military. And so how does that change? I mean, from your standpoint, when you look from the geopolitical, how does that influence AI adoption growth?
It'll speed it up, right? The fact that the world is generally rearming, no matter how you want to call it, will speed up. Much of our innovation has come from military.
And I will say, there's been military cycles in the past, which you could argue also part of that equation
it's not a coincidence that during the war, World War II, you saw big increases in productivity. Well, that was also military.
Yeah.
I was listening to an interesting fact today that during World War II, the Japanese restricted rubber exports. So the Americans had to rapidly figure out a new way to create synthetic rubber, otherwise we would have. And so when you go through with military, because there's always a need, capital is not really the constraint. It's we have to have this. Your speed of innovation, it can be quicker. So I would think that would cause it to go faster. I would make a point though that like I look at my kids using AI, and a lot of this is sometimes generational. Like I won't be AI native. I'm going to figure out how to use it in my life, but it's not something that is going to come naturally because I'm getting older and I'm just not good at learning things as I used to be. And so I think it'll be one of the things that causes the rate of adoption to slow is just people's comfort with using it, and you'll really see it over time as the workforce rolls over and you have next generation workers who are much more adept. And just like I might have been when I started using the internet 25 years ago, it was easy to kind of, because I never knew any different. I looked at the way people were doing things, and that's kind of crazy. I can use email, or I can use inter-office mail. And so I think that's also an impediment to the speed of adoption is just people getting comfortable. And one of the things with AI is it's really powerful if you're creative. If you've got like a concept you're trying to do, you can do it. That generally doesn't reflect the entire workforce. That's like a slice. You got your creatives, but everybody else, it's they're not waking up in the morning thinking, how can I do whatever I do with AI? And so I just think that AI native kind of employee is something that will come over time, but isn't it's not going to happen next week.
On the point of the superpower conflict and what that means for AI and technological change. One thing it means is there will be no regulation in the United States. And we definitely need regulation in terms of privacy, copyright, child protection, a host of things.
And what you hear from media is that no one's doing that. Like you hear they're all racing because they want to be the ones to be responsible to do it, but no one's actually doing it. So
there's a little bit at the state level, but at the federal level, and ultimately, overall, there will be no regulatory hurdles for the development of AI. And you can imagine as we have AVs roll out and drones and different types of robots, you'd say, we'd probably like a bit of regulation, but there won't be any.
And so what happens? Something bad happens, and we overregulate.
It's interesting too, because I guess I am trying to. You're saying it's not different. This has been given all the historical cycles. This is what it does. But the other thing I wonder sometimes too is that the difference with like a railroad or a book, like Gutenberg, they had a press. The rich had it. It was in a room. I know people, and I've talked to them, if they're in a market in Nigeria and they're using, it's on their phones. And so I always wonder sometimes if that speeds things up a little bit because it gets used a different way. But
I think there's an argument that things happen in the world of bits more quickly than things in the world of atoms.
What do you mean by that? Because I've heard that. And it's like, tell me like I'm 12.
So the digital world. And so as Michael was saying, with intangible capital, the way the internet could work or different aspects of AI. So you can scale it immediately, and you can have it in Toronto or New York or in Nigeria, and it happens at the same speed, where physical capital, it's much more slowly to diffuse across the economy. So that's one argument, but ultimately, you're going to need it. We all live in the physical world, and a lot of what's going to change the world isn't the ethereal aspect of AI. It's going to be the physical part of AI, and that just takes a long time.
Remember,
it's slow.
AI is both a digital and a physical medium, right? So
Yeah.
ChatGPT, Gemini, that's today.
Yeah.
But in terms of how we use it, I mean, I think Kevin writes in his paper, Edison invented the light bulb. It took 50 years for people to have light bulbs in their houses, and I don't think it's going to take 50 years.
But only the rich people could have it. I guess that's what I was wondering, right? Because I think there's a more of a diffusion faster.
Thing. AI is, for sure. Again, in using it on my phone, it's fairly inexpensive.
Yeah.
But in terms of rolling out, buying autonomous vehicles, now you're talking a whole other, that's a much more complicated use case.
Yeah.
And you know, that idea of the March of Nines where it takes 20% of the time to get to 90%. Well, when you're driving an autonomous vehicle, you don't want it 90% accurate. You want it 100% accurate.
Let's talk about that phrase, because you have that in there too, about engineering hurdles in the March of Nines. Let me say to you, like I think it is, but you know, the March of Nines mean the reliability of something. So it's 99.999% accurate, which is what you hope. You hope your air traffic control is 100% accurate, right?
Yeah.
So tell me just what you mean by that in the paper, though.
Yeah, so Mike was talking about driving. So, you know, I've taught 3 of my kids to drive. And so they pretty quickly get up to 90% and they get a lot of confidence. But
90%.
Yeah, 90.
I'm not driving with them. Sorry, I was going to say like a little higher.
But
anyway.
actually, you'd like them to get 99% reliable and maybe 5.9, so 99.999. In some things in the world, 90% is fine. So if I'm sending an email to a colleague, maybe 90% is okay. If I'm doing marketing copy, maybe 90% is okay. So there's some things in life, 90% is okay. But if we're talking about radiology, if we're talking about nuclear power plants, autonomous vehicles, if you're going to be talking about a 600-pound robot in your home, you don't want 90% reliability. You want at least 5 nines.
Yeah.
And so, and that is, we get very excited when there's a prototype, a demo, because they've reached 90%. And so they have a good marketing event, and we get really excited. But that gets you maybe 20% of the way to product that can be commercialized. And maybe it's taken you 5 years to get to 90%. Well, if you're 1/5 of the way, then you've got another 2 decades before it is a product that's going to diverge.
The fun part is the prototype. The hard work is the commercialization of it.
Yeah,
right?
yeah. So if I say this back to you, so it means we can demo things, create things, but until things are 99.59s, you can't roll them out to the rest of the world because they're not safe, and that's going to impede productivity over time for AI.
Yeah, and I think the Edison quote that I think a lot of us are familiar with, that innovation is 1% inspiration in 99% perspiration.
Yeah.
I think it's sort of that point.
Yeah.
You get this, you have the light bulb, it's incandescent, that is great, but that was 1880. 1924, you had 50% of homes having light in there. So it takes a long time.
So taking back to the market, got a lot of companies that have been tens of billions of dollars of market cap, not earning any money. So you're bleeding. And so either you have constant new flows of capital to keep going, or at some point you got to turn a profit. And for a lot of those companies, great ideas, but they won't see the light. They won't see a profit.
Yeah.
And you can only go so long before investors, and it's certainly not things we invest in, but investors who are more speculative in nature are going to say, I'm forced with a decision. Either I pony up another round of financing, or just cut my losses.
Yeah.
And I think that will be played over and over again as we go through this. And that's going to create, and the challenge is we're not starting out with companies that are, $500 million or $1 billion. They're actually been bid up to astronomical levels. And there's a lot of, this is really, really problematic in the private market, where you've got a lot of companies that aren't public yet that have these kind of phantom, it's worth $500 billion based on seed rounds of a few billion, and they've used that as a multiple. There's just no way the market's going to absorb this if it's not actually showing a likelihood of making money in the near future.
It's going to make for a very interesting IPO calendar if things start coming out.
Yeah, to the extent people ask if there's an AI bubble, that's far too broad a term, far too binary term, because in public markets, these companies are producing enormous amounts of cash.
Yes.
In private markets, as Mike was mentioning, you have some companies that have 6 people. They don't have a product. They don't really have an idea of the product, and they're valued at $10 billion.
But they have AI in their title?
Yeah, and so VC world has a lot of cash from American investors, from Middle East investors, from investors all over the world. And I think that, to the extent that there is a bubble and there's going to be a lot of companies that don't make it, and this is always the case, it's more in the VC private world than in public markets.
You're not making me feel very optimistic right now, but I'm going to come back. We're going to talk about implications for investors.
I will push back on that a little.
Yeah.
There is a lot of interesting things to invest in right now.
Yeah.
Because as we think about AI in the physical world, it needs a lot of input. And those are the places where you can make a lot of money.
Yeah.
Right. In terms of thinking about where are the bottlenecks and what do I want to own and and there's a lot of them. And so I think the market has started to sniff this out.
Yeah.
But I think this is going to be a theme that has some durability and it'll play out over the next couple of years.
I think I heard it was some of your team members, I can't remember, but talked about the first derivative AI trade. So it's kind of the obvious ones that you're seeing. And then there's kind of the second, third, maybe these are the things that the bottlenecks you're talking about in terms of what's coming. I'm going through another one here. You talked about the reason why this is going to take longer from a productivity standpoint is substitution of capital for labor. And you just basically, it's a slow process. And you kind of highlighted, I think, all the reasons why, I think. But is there anything we haven't talked about that you want to add to say why it might be slower?
Yeah, so this is more the economics perspective.
Yeah.
And in particular, there's a great study from two economists at Stanford. But basically, we're richer than our grandparents because we've managed to automate, which means substituting slowly improving labor for quickly improving capital. And typically, that's been physical capital. And you can imagine this is something that happens quickly, but for reasons we've been talking about, it happens really slowly. Capital improves 10 times more quickly than labor, sort of over the period since 1950, that's the case. So you'd want, in some instances, to have more quick sort of substitution, but it's a slow process because the structure of economies and institutions and everything is very layered and complex. So it's a good thing. It's why we're richer than our grandparents, but it happens much slower than the techno-optimists would have us believe. I'd also like to get on the point where you were saying we weren't making you feel very good. We're quite constructive on equity markets.
I know you are, yeah.
The liquidity looks really good. Earnings is good. We just think there's going to be diversification. There's been overly concentrated bets in U.S. tech. But beyond, and even within tech, there's a lot of opportunities. But we think it's time for investors to be looking at markets outside of those highly concentrated bets.
I want to just go right directly then in because I think we've covered a lot in terms of the why it's going to take longer and played that out. But for the implications for investors, you talk about, you do expect CapEx growth to moderate to a more sustainable, and I'm assuming this is as companies can't show
at some point.
The ROI.
Although Google proved us wrong this week, so maybe not quite yet, but at some point.
Not yet.
I could check my phone. I'm sure there's something right now that's just happened that will tell me differently. You talk about quality tech companies with sustainable free cash flow and established user bases, rather than speculative startups. Can you give me a little color around that? Because what makes quality tech beyond that?
So when you're at the pivot stage of a tech wave, you don't really know what the applications are going to be. So to the extent that we're in a period analogous, say, to 1998, at that point, there wasn't a Google, there wasn't a Facebook, Airbnb, or Uber, and these things. So the applications, you don't really know. But the infrastructure, you have some idea of how the infrastructure is being built out, and Michael's talked about some of those opportunities. And you also have the companies that have big user base. They're producing free cash flow now. So it's not hope or hype companies. So they're real companies with real earnings, and they're going to be part of AI, this new tech wave, as it evolves. And so that's what we're thinking as being the quality part of tech rather than the hype or hope, very speculative part of it.
Anything to add? I'm trying to, I guess what I'm thinking is like what? I don't want names. I don't, because I know you can't. But I'm just going to say like just some concrete kind of examples of how to think about this.
Well, there is this incredible intersection right now of themes. To our point about this cap light world going to a cap heavy world, you don't have to look very far to see industrial policies evolving quickly, and countries recognizing that we've got a deficit of investment in real things. And it goes back to that, looking for companies who are doing good return on invested capital, and looking at where it's almost like love free cash flow, but right now we're at a point where we're investing. So who are the good capital allocators? Who are building the things that we need? And so this gets you into industrials, infrastructure, materials, being energy, being kind of critical, underinvested areas. I was joking with someone today, if you were starting out today, if you're just, what should I do in university? Well, mining companies are dying for mining
true,
engineers.
right?
Like if you can find a school that teaches it.
Yeah.
And so I think those are the areas that are going to be quite lucrative.
Yeah.
And so from our perspective, I just think that this concentration of investment into a very small part of the world is about to diffuse. And it's time to start looking at other places that have been really ignored for, I look at just looking at my Bloomberg, and it's, 15 years where things have just gone nowhere, and all of a sudden they're starting to move, and
yeah.
it'd be copper, nickel, aluminum, pipes, energy companies. So I think we're starting to see the early innings of a rotation of capital. It's not that you sell U.S. so much as your marginal dollar should be looking elsewhere and other places to go, or looking at parts of the U.S. market that have the other 490 stocks in the S&P that have done pretty much nothing over the last little while.
You also mentioned here, and it's just to dovetail, but diversifying beyond concentrated bets in U.S. tech.
Yeah.
One thing I guess I'd be interested to understand your thoughts on is that, there's the evolution of, I'll say, sovereign AI. When you talk about this, when you have to own certain things. So, the U.S., and again, I'm not a technologist, but you have you think about an AI stack that's out of the States, maybe a Chinese AI stack, and how do you navigate all that stuff? When you kind of think about diversify away from U.S. tech. I mean, any thoughts on that?
I think technology is always a key component of sovereignty, and so you're going to have control of your supply chain. Hopefully, working with allies, and that's going to be important in semiconductors, rare earths. No country can do that, so you have to work with allies. But a sovereign approach, and also AI, encompasses a lot of culture, and certainly the big tech companies, they export a lot of American culture. And so the extent that countries don't want to subsume that culture and effectively be American, they are going to have to be thinking about that. So
Which
I think
is happening.
Sovereign AI, both in terms of the supply chain and also all of the culture that's embedded in technology, it's always the case, but particularly with AI, I think it's important for countries to have an explicit policy on how they're thinking about it, rather than just passively absorbing it, which I think is what most countries have done over the last 25 years. But I think that's really changing.
Yep.
How does that translate, I guess, into your thoughts, but where you kind of think about where, does that, I mean, it's pretty granular. I know to kind of say, what does that mean for an asset allocation thought? But how do you factor that in? Does it change anything, or?
Well, every country has its slice of people that create wealth, and I think that we've overallocated people and money to the U.S. Market, and so we're generally looking for opportunities elsewhere.
Yeah. So it's seeding all these opportunities elsewhere.
I mean, Asia's really running. I think there's a lot of interesting things that are occurring right now in Japan, which has a tremendous history of robotics and engineering. South Korea, even parts of China look interesting. In Canada, we are going to be at the beginning of the supply chain in terms of materials, and so there's opportunities as we start thinking about more of a national strategy on resource extraction. And so this is where people talk about diversification, and I hate the word sometimes because we just use it so much. We don't actually explain what it means, and it means looking at a theme, but spreading out your investments across that theme so that you don't get pinched at any certain point. And I think this is the way that we're thinking about it right now in terms of that kind of broader ecosystem of what's going to be required, and it's a lot. On top of everything else that's happening, military spend, industrial spend, infrastructure spend, et cetera.
And I guess a few last questions for you. So when you think about, and thank you, because I think you really spelled this out nicely in terms of very exciting, just be patient, because it's going to play out. Could you be wrong? Is there something where you say, these are the areas where, you said at the very beginning, in all of history, we've never seen this, but, and I would just say things like, AI becomes, so powerful in what it describes that maybe we're no longer mining, maybe we're creating materials, there's other ways. Is there something there?
I think that, the one thing you got to, where the moats that AI is going to be able to overcome quicker is probably in the more digital side and the intangible side, where you could get change a lot faster. And I'm kind of alluding to what's already happening right now in certain certain software, with the software index in general, but in particular certain software companies where all of a sudden they've got a bit of a real kind of risk in front of them. So that's where I think you get AI disrupting quicker. But it's not going to replace oil anytime soon. It is not going to replace, perhaps we can make SMRs more efficient using AI, but that's going to take a long time. Yeah. So this is where I don't think we're wrong so much, but we just had to think about our comments and make sure that this is not about ChatGPT or Gemini or how we're using it today. It's the applications and where are businesses more vulnerable to major disruption of AI faster. And I think that is, I'm just playing out already, but that's something to think about and in terms of how this technology, which is different than, it's hard to think back about major technology or technological revolutions where you've seen the first victim so quickly. This one is happening at rapid speed. But that's the world we live in, right? Where things do move quicker, per se.
Kevin?
Yeah, so one of the takeaways in the paper is that at this stage of a tech wave, it is easier to spot the losers than the winners. And as Michael was saying, with software, that seems to be happening. In terms of how we're thinking about the overall tech stack, I think it's important. We have the industries of the future. So we've talked a lot about robotics, AVs, drones, and then sort of upstream from them in the supply chain, you're going to need lots of sensors. You're going to need better batteries. You're going to need actuators, and you're going to need data centers, the transformers, generators, everything goes on. And then upstream from that, you're going to need a lot of the raw materials. And Michael was mentioning hydrocarbons, but rare earths, and a host of things. So there's different aspects of the chain that are really important, and there's value in all of those. And I think that's quite exciting. Yeah. As investors, and I think it's going to be core to how we're thinking about investing going forward.
I guess, two last questions. I keep saying it's last, but one thing I was taking a look, and we've talked about this, and the term AI slop is out there where people, it's like models, and this is just LLM, it's not the physical AI you're talking about, but models scrape to learn, but if they're scraping themselves, doing AI slop and things collapse, is there anything where we're just I don't know, just something happens where the model becomes ineffective and people don't rely on it anymore?
Yeah, so this is the scaling law. Yeah. So the idea right now is we stay with LLM architecture, so the transformer architecture, and then we add more compute, more data, and it gets better. And so far, it is getting better. So
It'll be diminishing.
There's no signs that that's really slowing down. So that is good.
Have you been to Molt Books? I was going to say.
And AI slop, because the training data that it's used, it's not the Wall Street Journal, it's not War and Peace, it's a lot of junk. It's trained on us, it's trained on the internet, a lot of it's awful. Yeah. And so it is going to hallucinate, it is going to garbage in, garbage out, there's going to be a lot of garbage coming out. And this is why sort of post-training, reinforcement learning has become much more important, and I think will continue to be important. But there's every indication that the current approach will continue to improve. Eventually we get diminishing returns. But really to go the step forward to physical AI, and the future of AI is physical AI, we need radically different architecture. It's not going to be transformers, LLMs. And it's going to be these world models.
Yeah, and I guess when you're saying that, I'm thinking physical AI is like the ingesting of real world data because it's what's actually happening.
Which is much harder.
Exactly. But that's what Elon Musk is doing with all the cars are doing with Tesla. And I guess the hope with Optimus, that's maybe why he wants to do it. So I still want an Optimus Prime, I'm just saying. I really want one. What is the one question or one thing we have not talked about that you think the people listening should be aware of around this conversation? Kevin, I'll start with you.
Why is this different than 26 years ago? And we think there's a bunch of reasons. One is valuations are stretched, but they're nothing like they were in 2000. Secondly, the companies at the core of what's going on now are producing enormous amounts of free cash flow. Thirdly, until recently, there hasn't been much issuance, where 26, 27 years ago, there's enormous debt and equity issues going on. I think another part of it, and Michael mentioned this earlier, when people were laying fiber optic cables 26 years ago, 97% of them were dark. That is, they weren't lit, they weren't being used. People were providing infrastructure ahead of demand. the situation with data centers and GPUs is totally different now, where there's enormous demand for these things. And the finally reason why it's different, and we're not going to be moving to sort of negative capex growth environment, is the AI superpower nature. We have to keep investing, and America and its allies have to be keeping up, maybe ahead of China.
Yeah.
So
it's an arms race.
So I think people like to ask, is this an AI bubble? And I think there's multiple reasons to think it's a very different situation than back then.
Mike?
The only thing we haven't talked about is the demand for capital, I think, is going to go higher.
Yeah.
So things where people have been parking their wealth that don't return, I think, are vulnerable. I think.
Can you just back up a bit and tell us when you say demand for capital, meaning like what is the current state and where do you think it's going to change? So what's been happening?
That we were talking about this capex cycle, which is going to be gargantuan.
Yeah.
It takes money.
Yeah.
And our starting point is governments are not in a great fiscal position. Mm-hmm. Households are rich, but there is a lot of money parked in things that don't really do much. And net, I think this generally will push yields higher in the bond market. So the world of which we had free money, which was the last decade, I know we're 6 years into this one, but yields haven't exploded higher. They're not terrible today. But my sense is that the direction of interest rates tends to trend higher in the years to come, not lower. Mm-hmm. Because we have the inflation volatility of a capex cycle where you've got mismatches, but also tempered with perhaps more increasing productivity and less pressures on labor cost. But the need for capital, I mean, the private markets, I think, really, really grew in a world when capital was free, 10 years ago. And now all of a sudden, we're going to say, actually, I'd like to see a return on that. So I think that this is good for investors. I mean, you want your money to have a better opportunity set for investment, but that does come with implications, and that is borrowing costs will be higher. And I think that is something that I would urge listeners just to be prepared for, and that I don't think it's realistic to see yields as low as they are going forward.
I have one last thing.
Yes.
Can we have a third last thing?
You may have a third, yes.
Just you, Kevin.
Yeah.
I think the K-shaped economy, I think this gets exacerbated by AI. So
Can we just in plain speak, because for people who may not know, the K-shaped economy means what?
So the upper leg does really well and the bottom leg doesn't do so well. So the upper leg would be the returns to capital and the returns to, say, the top quintile.
Yeah, the wealthy.
Wealthy, but sort of
wealthy and moving up.
Yeah. So I think they do really well in this environment, and so the returns to capital and the capital share, I think, will be good. In fact, the labor share rate now in the United States is at a historical low, and it's in a pretty awful trajectory. I think that continues, and I think that raises a lot of challenges as investors. Can you just before you say that raises a lot of challenges, like what? Well, so if you have the bottom three income quintiles not doing terribly well, getting a smaller piece of the pie,
it's stability.
In democracy, they will demand more. So one thing I think will happen is the demand for transfers from the government get bigger. And I think it's underappreciated that about 25% of U.S. GDP is transfers to lower income groups.
Is it really?
If you measure it broadly, and I think that continues to go higher. Americans, I'm based in New York, Americans don't like taxes. So this means deficits stay at 6 or 7% of GDP. The debt level keeps going up. In a world in which we're sort of capital constrained, I think we end up with financial repression, because the number one job of Treasury Secretary Scott Bessent is to keep the yield curve from moving up.
I think we have a topic of our next podcast.
I was going to say, do you want a second last word too?
No.
Okay. We'll get Kevin last one. Yeah. It is such a pleasure to have you both here. Thanks so much.
Okay. Thanks, pleasure.
Thanks for tuning in to this episode of the Money Talk Podcast, brought to you by TD Wealth, recorded February 5th, 2026. The information contained herein has been provided by TD Wealth and is for information purposes only. The information has been drawn from sources believed to be reliable. The information does not provide financial, legal, tax, or investment advice. Particular investment, tax, or trading strategies should be evaluated relative to each individual's objectives and risk tolerance. The views expressed are those of Kevin Hebner, Managing Director, Global Investment Strategist at TD Epoch, and Michael Craig, Managing Director, Head of Asset Allocation and Derivatives at TD Asset Management, as of February 5th, 2026, and are subject to change based on market and other conditions. Certain statements in this presentation may contain forward-looking statements that are predictive in nature and may include words such as expects, anticipates, intends, believes, estimates, and similar forward-looking expressions or negative versions thereof. Forward-looking statements are based on current expectations and projections about future general economic, political, and relevant market factors, such as interest and foreign exchange rates, equity and capital markets, the general business environment, assuming no changes to tax or other laws or government regulation or catastrophic events. Expectations and projections about future events are inherently subject to risks and uncertainties which may be unforeseeable. Such expectations and projections may be incorrect in the future. Forward-looking statements are not guarantees of future performance. Actual events could differ materially from those expressed or implied in any forward-looking statements. A number of important factors, including those factors set out above, can contribute to these digressions. You should avoid placing any reliance on forward-looking statements. TD Wealth represents the products and services offered by TD Waterhouse Canada, TD Waterhouse Private Investment Council, TD Wealth Private Banking offered by the Toronto-Dominion Bank, and TD Wealth Private Trust offered by the Canada Trust Company. Epoch Investment Partners, TD Epoch, is a wholly owned subsidiary of the Toronto-Dominion Bank and an affiliate of TD Asset Management. TD Asset Management is a wholly owned subsidiary of the Toronto-Dominion Bank. The TD logo and other TD trademarks are the property of the Toronto-Dominion Bank or its subsidiaries.